Good morning. This is Unit 13 in Business Ethics at Newberry College in the fall of 2021. This is Chapter 10, the last chapter in our book, and it's entitled Ethical Decision Making, Corporate Governance, Accounting, and Finance. And the chapter starts with several quotes about corporate governance, accounting, and finance. And I'm going to read all of them. I think they're really excellent. It astounds me how little senior management gets a basic truth. If your clients don't trust you, they will eventually stop doing business with you. It doesn't matter how smart you are. And that was Greg Smith, who was explaining why he was leaving Goldman Sachs back in 2012. Doesn't seem to have hurt Goldman Sachs much, but at least Greg Smith still has his standards. Then from Peter Drucker, whenever an institution malfunctions as consistently as boards of directors have in every major fiasco of the last 40 or 50 years, it's futile to blame men. It is the institution that malfunctions. Maybe. It is essential that the activities of corporate executives are under constant, vigorous, and public scrutiny, because those activities are crucial to the economic well-being of society. That's Ann Crotty, and that's probably the quote I agree with the most. And I've included all the quotes to begin the chapter, this final unit of the semester. I don't agree completely with Professor Drucker for once. I usually do, but I think that boards of directors of public companies are in the maybe tens of thousands, hundreds of thousands of men and women who, for the overwhelming majority, work hard to oversee and discipline their organizations. And the institution in general works well. We don't ever hear about the problems that were solved before they became scandals, or as Drucker says, fiascos. And I'm sure that they take care of many of those. There are perhaps 15 to 20,000 business organizations and investment groups which regularly report their financial information and other information to the SEC. And only a few of them have been involved in horrible fiascos over the last 30 to 40 years, which have destroyed the companies. Now, you'll find a lot of footfall. You'll find a lot of SEC enforcement actions in which companies have had problems in their compliance and are disciplined by the Securities and Exchange Commission. But only a few really, market-affecting fiascos, in Drucker's words. In my experience, the standards of ethical behavior of these corporate boards are superior to those of members of government in the executive and legislative branches, and even a few lawyers, even some DAs in the judicial branch. In any event, but this is, corporate governance is a big issue and certainly a big ethical issue. And so that's why we're studying it here in the last part of the course. So we had a cold opening about a really big fiasco, and that was Volkswagen's diesel fraud. And this was the 2015 VW scandal, in which Volkswagen had programmed its diesel automobiles' emission control systems to only operate when they were being tested by regulators. When operated normally by consumers, the owners, the cars emitted 30 times the legal limit of nitrous oxides, a regulated pollutant. And Volkswagen's board accused management of either A, hiding the fraud, or B, not being aware of the fraud. Now, I wonder which would be worse as a manager, to hide the fraud or not be aware of it. I guess sins of omission are perhaps slightly less evil than sins of commission. But in any event, it was quite quite a disaster for Volkswagen. Then Volkswagen did an internal investigation, which, surprise, surprise, cleared management of knowing wrongdoing. So I guess they decided that they didn't know about it. I know nothing, like Schultz perhaps back in Hogan's Heroes. I know nothing, I see nothing, which does not reflect well on Germans given their history. Volkswagen suffered $30 billion in fines, costs, and penalties, as well as the cost to repair those faulty vehicles, the diesel vehicles. And Volkswagen's board structure was set up in a way that made assignment of responsibility more difficult. So there were a lot of people who had deniability because in Germany, the board of directors has to have 50% of the seats represented by workers, not by investors or managers. And so the German unions had a big role on the board, and I think politically it's difficult often to hold those union representatives responsible for decisions that managers are making, and government representatives are on the board of German companies as well. So, the regulators on boards of companies don't always work to regulate the companies, and so that's a problem in holding a German company top executive management accountable in a situation like this. So the VW fraud shocked the car industry because Volkswagen had enjoyed a long reputation as a technological innovator and an ethical operator. But remember, back to the beginning of the course, as Warren Buffett said, it takes a generation to build a reputation and 5 minutes to destroy it. And whoever created and approved the anti-emissions control programming and whoever approved it should have been immediately fired. Volkswagen's worldwide sales dropped by 25% in the wake of the scandal. Now think about that. This is a company with hundreds of thousands of employees worldwide, and you lose 25% of your sales. That's incredible. And yes, Volkswagen did, in the aftermath, fire the head of its U.S. operations, its top manager in the United States, and the head of research and development in both the United States and Europe. So, big scandal, but one that's maybe not all that satisfying to read about. It seems as though the enforcement and the assignment of accountability was more symbolic than real. And so in any event, maybe the U.S. board structure works better. It's less filled with political conflicts, at least. Okay, our chapter objectives, this is slide number 4, are for this particular unit and the last chapter of the book, Unit 13, Chapter 10. Accountants and other professionals as gatekeepers. Then we're going to look at conflicts of interest, a big term that you hear about. We'll study what it actually means. Sarbanes-Oxley Act requirements, the COSO framework, the control environment and internal controls and the means by which culture and ethics can impact it, legal obligations of a member of the board of directors, ethical obligations of a member of the board, conflicts of interest in the financial market and how they might be alleviated, excessive executive compensation, and then we'll finish with insider trading. Insider trading is also a defined term, and we'll talk about what that is as well. So this is a chapter with 10 learning objectives. It focuses on some of the top legal and regulatory issues in business today, especially for top management. Business today, especially big business, is so regulated today that some managers have described it as walking a tightrope. Some probably feel as though they're walking a tightrope in the middle of a hurricane. But with great responsibility also comes great opportunity. If you can keep your eyes focused on the target and proceed carefully, you can stay on the rope and you can reach your goal. Okay, topic number 1, accountants and other professionals as gatekeepers. We define the term corporate governance. That's the structure by which corporations are managed, directed, and controlled toward the objectives of fairness, accountability, and transparency. The structure will generally, the relationship between the board of directors and the shareholders or other owners. So, I believe that slide maybe should say generally define the relationship between the board of directors and the shareholders or other owners and executives or management. And note the Enron scandal and the discussion of the LIBOR cheating scandal from before in our book. That's rehashed here with a slightly different take. Accountants, lawyers, auditors, and financial analysts act as gatekeepers or watchdogs to ensure that businesses are playing by the rules and conforming to the conditions that ensure the market functions as it's supposed to do. And I'll talk about that a little bit more because I'm both an accountant and a lawyer. And there are important differences between their roles. Accountants as auditors have duties to users of the business's financial statements and a duty to be independent of financial ties to the business being audited. So I'm a lawyer, and lawyers are required to keep their clients' confidences. Now, there are exceptions to that, and sometimes when you are representing a corporation, you can find that executives think that they can speak to you in confidence because you represent them, but if you represent the entity and not the individual, then perhaps that is an exception to that confidentiality obligation. I'm also a CPA, and I worked with a big accounting firm for a few years, and I'm familiar with the rules regarding conflicts of interest. When you're on the professional staff of a CPA firm, you are prohibited from personally investing in any security issued by a company for whom the firm has a test function, where they have to attest the financial statements. That's where the CPA firm audits or reviews the financial statements of that company or perhaps some segment of that company. In the Enron scandal, the conflict of interest that was involved there involved auditors who had many fee-based relationships as consultants with the company they were auditing. So Arthur Andersen, which was their auditor, also had its professional staff deeply involved in providing consulting services to Enron. And in that situation, the audit engagement is typically bid for, and it is very competitive, and it is very low margin for the accounting firm. They have to do a lot of things to comply with the audit standards, and they don't get paid very well. They don't have the $1,000 per hour partners being able to charge a lot of time to those engagements. But on the consulting side of things, where you can show that the company, that you're providing value to them, you can value bill those engagements, and oftentimes you can collect your whole fee. And so the consulting partners at Arthur Andersen, were supposedly the tail of the dog, but they made such high margins in their work as consultants that they were the tail that wagged the dog. They were able to, have more input into the client relationship than the auditors did, and they were either able to bully or hide a lot of the things they were doing on the consulting side to help Enron create and to maintain its fraud, and so that was not disclosed to the public by the auditors as it perhaps should have been. Whenever you suspect that a company is in trouble, and you read in the financial press, you read in the New York Times or the Wall Street Journal or some other big newspaper that covers these things, that the company is changing auditors or that the CFO has resigned or been fired, there's a major scandal with that company that's about to break. That's usually one of the first indications. Let's go on to the second topic, slide number 6, conflicts of interest. A conflict of interest exists where a person holds a position of trust that requires that he or she exercise independent judgment on behalf of others, but where her or his personal interests or obligations conflict with the proper exercise of that judgment. So that's the definition of a conflict of interest. In short, it's where professional duties conflict with personal interests. It can refer to professional duties conflicting with other professional duties. So if you have, if you're perhaps a CPA and you're advising General Motors, and then you're also advising Ford, you may have a conflict of interest because they're competitors. Do you give them the same advice, knowing that if they adopt it both, neither will benefit? Who do you give the best advice to? So that's a conflict right there. Or perhaps you feel as though the type of advice that you're giving them is just making them both more efficient, and so they'll both benefit. So that's perhaps an area where it's an apparent conflict, but not an actual one. Fiduciary duties. Fiduciary duties are a professional and ethical obligation to put an obligation to another person above the professional's own interests. I've actually got something to say about that. That's a very interesting trend, and something that's a nice way of looking at things from an ethical standpoint. And notice figure 10.1 regarding conflicts of interest in public CPA firms. I think that's a good illustration. Okay, note the decision point. Now this is important. What to do when faced with a conflict of interest. And the book recommends 2 very practical things and effective things to do when you're faced with a conflict of interest. One is to notify the relevant stakeholders, notify the people who could potentially be affected by the conflict, and 2, remove yourself immediately from decision making. This is excellent advice, and this is what I would advise a client to do if asked that question for one of my legal clients. However, I would hope that my clients would avoid conflicts proactively, such as by putting investments in blind trusts when they have positions of power to affect the investments, disposing of them before accepting positions of responsibility in which there might be or is an actual financial conflict. That's such an unforced error that among top executives, it really can't be excused. Also avoiding nepotism and office relationships. That's oftentimes a conflict and one that has created many scandals. Don't hire your kids unless you own 100% or close to it of the business. Same for other close relatives and even close friends. If you're a decent manager, you will probably will have a hard time being both the boss and a friend to others at the same time. It's a little bit like being their teacher, like being their professor. You can like your students, but you can't always be their buddy when they're not doing well. Do you remember the scene at the beginning of the movie The Godfather, the wedding scene where Don Corleone, the Marlon Brando character, is receiving guests at his daughter's wedding in private and agreeing to do a service for them in exchange for their pledge of loyalty and their agreement to be under an obligation to do him a service in the future? Remember, he has the reluctant undertaker who doesn't really want to be his friend. He says, "Be my friend," to the undertaker, and he's a little reluctant to be under obligation to the mafia chief. He just wants to pay him in cash and not have to worry about what's going to happen later. But then later in the movie, after he has accepted and after his daughter has been avenged, the undertaker has to meet Don Corleone to repay the obligation, and he's terrified. He's just terrified. Is the Don going to bring him a murder victim's body to dispose of secretly? Is he going to involve the undertaker in a crime? And then the undertaker is both shocked and relieved when the dead body is the Don's own son, Sonny, who was brutally murdered at the toll booth. And that's sort of like business friendship. You're never really friends, and you have second thoughts about the other guy, even when it turns out that he has the good judgment not to ask you to violate your own standard of ethics. It's also Hollywood. In real life, your so-called mafia friends would ask you to help chop up the victims' bodies and dump them in the meadowlands or out in the ocean, like in Donnie Brasco, which was based on real-life mafiosos. Even if you're in an ethical business, not organized crime, which I hope happens to all of you, an ethical business, not don't join the mafia. That would be a bad idea. You know, they keep trying to get out. They keep dragging you back in. Business friendships are going to provide the potential for conflicts of interest in office politics, performance reviews, and other matters. And my dad was a good example of this. He had a business partner for almost his entire life. And my father's dad had actually been partners with that guy's father in a couple of automobile dealerships. And my whole life, we only had one cookout with them. And that was the only time I ever saw them, even though our families had kids the same age. And, you know, we lived in the same relatively small suburban town. We even competed on the same youth sports teams, but we were never encouraged to be friends or to socialize in any way. I think if our families had been closer, it would have presented the potential for conflicts in the business, which went through some very tough times in the automobile business and the business cycles of the 1960s and the 1970s. So avoid conflicts of interest whenever you can and be alert to them, and try to keep yourself out of situations in which you can either have personal or professional conflicts. The next topic, this is slide number 7, is the Sarbanes-Oxley Act requirements. This was an act from 2002 that was enacted shortly after and in direct response to the Enron scandal. And it was controversial for the high cost of compliance. It was a major obstacle for small public companies or for companies that wanted to go public and become a public company. In fact, some companies, I believe, went private because of Sarbanes-Oxley. And sometimes it's abbreviated SAROX or SOX, you know, S-OX or something like that. But it regulates a lot of financial activities among public companies. It regulates services by accounting firms outside the scope of auditors, the independence of public company audit committees, lawyers' reporting of concerns of wrongdoing by public companies. It requires management's assessment of internal controls, and we'll get into that the next couple of slides. Internal controls, defined term. Codes of ethics for senior financial officers are required. Hiring and disclosure of audit committee financial experts, and a sign-off on the financial statements by C-level, C-suite level management. The CEO and the CFO have to actually sign off on the financial statements as being fair and accurate, reasonably presenting the financial condition of the company. It's not enough for them just to rely on, hey, we got this audit report from our CPA who says we're fine. No, they have to say it's fine too. So the Enron scandal made it crystal clear that the big public accounting firms that performed auditing services for public companies could be corrupted when they were selling tax, business, compliance, IT, and other services to those same companies. The auditing services were a commodity and the profit margin was low, as we talked about before. The consulting services were value added, and the consultants in the big accounting firms earned higher fees and had more control over the client relationship. So that was a huge conflict of interest for the big accounting firms, and Sarbanes-Oxley required that public accounting firms providing audit services had to be independent, not only in the technical ownership test, the employees couldn't own the stock, but also in the more subtle relationships like not earning consulting revenue from those same companies. Sarbanes-Oxley also pointed out that senior management of public companies had to take personal responsibility for the accuracy of the financial statements. They couldn't hide behind the technical expertise of the auditors. So the CEO and CFO couldn't then manage the earnings of the company and then claim later that they thought the books were okay because the auditors gave them a clean opinion. Now the CEO and CFO have to sign off on those financials, and as noted above, whenever there's a company that seems a little shaky and the CFO resigns or gets fired, you can bet there's going to be a major restatement of earnings or some other disclosure creating a scandal for the company. And with that, we're at 25 minutes of this lecture. I'm going to take a break, and then we'll finish in part 2. So this is the first half of Unit 13, and we'll see you again soon. Bye-bye.